And over here, you have this one guy who's been waiting for the market to crash since 2020.
Oh, wow.
Today, folks, I'm sure there's many of you that can relate to this, but we need to talk about the boom-bust cycle we're living through when it comes to AI and what the actual reality is saying behind the earnings reports with NVIDIA that recently posted. We got to talk more about the banks. We're seeing Google rally and so much more in between, but I really want to talk first and foremost about building out a robust mindset in full-blown bull markets, because there's a lot of channels like Beavis Wealth, including my own, that have been talking about this. This may be an AI bubble. Here's a warning. Everything Money, I haven't talked about in a while, recently said, this always happens right before a stock market crash, and this is fueling one and one thing only: clicks, views, and capital, baby. As the king of the Finfluencer clowns on this platform, I'm here to share with you something that will hopefully kind of alleviate your concerns and try and stop you from doing something detrimental to your portfolio. But if you're on a path to financial independence, if you damn well one day want to retire early, join me by hitting that subscribe button, folks, because we'll just take a quick listen to the intro of this and why it's so performative in nature.
The last time the world's best investors positioned their portfolios like this was right before the 2008 crash. Back then, while most people were losing their shirts, these super investors quietly set themselves up for massive wins. And today, we're seeing those exact same moves. Warren Buffett is trimming his Apple position, but piling into oil, piling into steel, piling into home builders. Mohnish Pabrai is scooping up coal and offshore drillers.
Firstly, there's so much wrong with everything that's already stated here that is infactual and cherry-picked for a narrative that he's doing in his performative art of trying to sell you into stock market investing in his chat groups. But firstly, they have really just been buying Constellation Brands, Domino's Pizzas, United Health. They're not really just gobbling up a lot of these steel and oil companies, but they have been for the last 5 years. And in fact, they've missed out on most of the major dips in technology because Warren Buffett has never bought a technology company in his life, and it's heavily detrimented those as shareholders. In fact, the only real thing they've been doing is stacking a lot of cash. I mean, Warren Buffett has record hundreds of billions of dollars now, $350+ billion. But as we skip through this video, obviously, let's just see kind of what the point narrates down to here. And I think you can find it right around here.
Here's the key. You don't need to predict what's going to happen tomorrow. You just need to know how to identify value and avoid overpaying.
Isn't that kind of predicting what happens tomorrow? Because how do you know you're overpaying if you're not trying to predict the future growth of the business? Again, this is something that's detrimented Warren Buffett because he couldn't look at technology and see the absolute ballooning growth period that was upon us in this technological revolution, guys. At the end of the day, everybody is a value investor, but when you're buying individual stocks and you're calling yourself a value investor, you're presuming you understand something about the future of that business, right? This is why I've talked about Google so relentlessly on this channel. This is why so many of you get bored of me, because a lot of you keep saying, do you not have opinions on other stocks? I'm sorry, I can't sit here and tell you about the dozens and thousands of investments that are out there. Sure, I can talk broadly, look at the fundamentals, say, hey, United Health looks like a great buy here based on the numbers, but what do I know about health insurance? I can't tell you about the future. But Google, whoo, baby, as someone that spends 6 figures a year on Google ads, runs his whole business through YouTube, and just understands the sphere of social media, this seems like a good investment fundamentally and from where I think it's going in the future. And I see the rhetoric, I see the hate, and I get that the stock was trading at probably suppressed values for what the actual fundamentals were screaming to me as a buy. Now, again, I could be wrong. I'm speculating, but like walking into the casino, I'm just trying to make bets that are 80 to 90% in my favor. There's always a chance of a black swan, so you can't make concentrated bets because you don't know what you don't know, and sometimes you get slapped upside the head, so you don't want to weight these things like 50% of your portfolio. Most healthy people say around 5%. You kind of got to gauge out what your risk is based on your age, your time horizon, all that in between. But let's talk about the AI bubble itself. Are we really in an AI bubble? And I've speculated this time and time again, and I'm telling you, the chickens will come to roost, because the gold market, the gold boom that happened way back when the pick guys that were selling to the miners were getting absolutely rich, but even that had its cycle, and it's similar to the cycle that we saw with the crypto boom in leading up till 2022, because there was no discussions of AI future leading into the 2022 bust where Nvidia dropped a whopping 70%, give or take, right? And then all of a sudden we didn't realize the massive scaling and cloud data center building out for these large language models that was about to be upon us. But honestly, again, those chickens will come to roost, but I don't know if that's a year from now, 5 years from now, because eventually we're going to reach parity with the market. Eventually the CapEx spending, because three or four companies are driving almost 30 or 40% of all the revenue right now that NVIDIA is generating. And we know that funnel can't last forever. I mean, there's just no way, right? But that doesn't mean it can't last for 2, 3, 5 years from now. And in the meantime, I mean, we're looking at net income here that is quickly approaching the largest net income of any mega top 10 company, being Google, that did $28 billion last quarter. So yeah, NVIDIA is about to surpass that, and it's still justifying its value today. I'm not saying NVIDIA is cheap or expensive here. I think if you're playing this and you're in this rally here, the only thing you can do is, do exactly what you should be doing and taking profits all the way up, diversifying and constantly building out your portfolio and just enjoying the ride while it lasts. Because again, these cycles all come through. The dot-com bubble, not calling this the dot-com bubble because back then companies weren't backed by crazy balance sheets with $100+ billion like Google has, in cash. We're not talking about the growth rates that these companies had back then. Like, again, guys, it's not a cheap market, and I think there's secular bubbles going on because these companies can't trade at wicked high values, and I don't think NVIDIA is trading at a wicked high value. The software side with Palantir, I think, is a conversation in and of itself, but look at the numbers. I mean, the numbers don't lie, guys. I mean, these growth rates are disgusting. I mean, next quarter, they're guiding for $54 billion damn dollars. Like, how do you sit here and say this is a bubble in one of the greatest growth periods in human history, driven by an AI technological boom that is going to transform the way we live our lives? Are we pulling ahead some value? Yes. In time, could that value be justified? Sure. But even if NVIDIA goes through a boom-bust cycle, you have to recognize, if you're buying the S&P 500 as an example here, guys, there's been many cycles like this with many other companies. I mean, it's not uncommon for, sectors to get dominated by a handful of companies. I mean, you look at the railroads, you look at some of the utility companies. Like, I mean, the utility sector, every sector is dominated. The insurer plays, like United Health. Every sector tends to have a few companies that tend to take over the vast majority of the market share. And that's why I'm comfortable concentrating. And I've told you guys this time and time again. I don't mind having ETFs concentrate certain sectors, because when those sectors start to underperform, other sectors will pick up. It's the ebb and flow nature of market cap weighted ETFs and things like, the technology that's taking up the top 10 right now. But if you look at even the banks and why I buy VDY, because I love concentrating the Canadian banks. VDY, I've said this time and time again, my favorite monthly paying Canadian dividend ETF, gives me the concentration I want while also diversifying me and taking the management off my back by doing a market cap weighted index basically to the Canadian dividend kings. And honestly, there's ebb and flow nature to this, but as we saw with the recent Royal Bank earnings that crushed, Royal Bank making up almost 15% of that ETF, we have TD second in line making up 10% of VDY, and this one isn't doing as good. And a lot of people are saying, like, why is TD dropping on its earnings? And I think the earnings were really robust and great, but you have to recognize the stock went on a massive bull run this year. It's been the best performing bank, kind of really driving up a lot of the sector as a whole. And when you look, I mean, the only thing that's really holding them back is the very volatile nature of their net income. And I mean, we've seen some of the headlines. TD reports higher Q3, but profit earnings affected by anti-money laundering charges. And if we take a look, the only thing I really care about is this revenue growth, which has been jaw-dropping at best. I mean, from 14.1 billion last year to 15.2 this time. There's some skewed nature recently because of the fines they've had to pay, payments they've had to put aside, in the mix of higher loan losses, which are starting to get alleviated. We're now seeing loan losses similar to the rest of the sector leveling off, going down. That's a good sign for stabilization of loans. But regardless, when you look at the net income, 3.8 billion, it's kind of in line from where it was last year. There's some volatility here. If you take a look at the 9-month ending, not a lot of growth going on. It's kind of getting skewed and mixed up with all these fines they have to pay, the restructuring of some assets. It's not the greatest picture, but we knew that was going to happen. But regardless, the stock has recovered quite nicely into the year, and this could only be presented as perhaps a buying opportunity that I continue to get exposure through cost averaging and VDY. And again, if you look at the rest of the sector, though, and why I told you like a basket, you should be collecting them all, because in total, I mean, up 17% year to date as a sector, and Canadian Imperial is actually up and doing quite decently on its earnings, because again, similar to the rest of the sector, guys, loan loss provisions are starting to go down. This is a great sign. No one's complaining about this. If you look at basic revenue growth, actually, not as crazy compared to 2024 for Canadian Imperial. It's actually been kind of flat, give or take. which is kind of interesting because if you look at the 12 months, I think there was 25 billion. It's not like the craziest growth stock compared to Royal Bank when it comes to earnings, but nonetheless, still EPS was 215, but this time, Q1 of 2025 was 219. But if you go back to like Q3, I mean, it was $1.47, $1.50. So we're up still quite materially. The growth sector, I'm calling it a growth sector, but the financial sector used to be a slow growing, very consistent place. And without immigration growth that Canada's cut off materially, I don't know how we're doing this on the back of what's supposed to be a recession in Canada. You should be wildly impressed by the numbers and the bolstering we're seeing from boring sectors of the market, right? And I'm forever grateful and thankful, but I was going to tell you that, hey, the banks are trading in a bubble. Royal Bank didn't deserve to be trading at high multiples. Canadian Imperial at a 13p. There was a time where Canadian Imperial was paying almost, I think, what was the highest yield this paid if we look up the dividend on macro trends? Because this was once upon a time the highest paying dividend yielding bank. I mean, it was hitting, look at that, at the drops of the pandemic, 11%, as high as 8%, and now it's paying the lowest dividend that's ever paid in its history. But again, if we see a continued bolstering of net income, earnings that are going to skyrocket, there's a good chance we're going to start seeing much higher dividend payments, because if you look at TD as an example here as well, their payout ratio is currently only 55%, which is quite low. And I mean, the sector as a whole has quite low payout ratios, so I wouldn't be surprised with extra net income in time we start getting more bolstered in a higher expected dividend increases. But time will tell. Regardless, guys, I just want you to kind of take a break. Don't be these people here that are constantly fear-mongering you into not buying the markets. These bull runs can last a very long time. And as we've seen for the last 5, 10, 15 years, Buffett hasn't bought any dips in the pandemic or the 2022 crash. He hasn't touched tech with the exception of Apple. He's just sitting on a huge amount of cash. Don't get caught into these rhetorics. Just buy what you think you know well. Don't over leverage it. Take profit on the way up and just keep cost averaging into the broader indexes. Focus on the few, cost average into the many. But I'll pass the question off to you. I'd love to know what you think in that comment section below.